Hey guys, sorry about that. Technical difficulties seems to be every time after 8 o'clock. My internet or OBS seems to be crashing, which is not great. Hello. So, what I was explaining here, right? Um, so this is the 10 year, this is the 30 year. Ignore where we're currently at. So we can see that in essence, what you're saying is you're laying out bids here, right? Because if you're doing it in the current bid, you lay it out here, they basically hit and then pull, and then you're left with a bad fill, they go offered. So you can't be doing this in the current bid and ask. I mean, you'll do it, I'd imagine, what on occasion, but typically you'll be layering here and here, or here and here, and then typically they'll tick down. They'll maybe pull 500 off it, so you're then say 1100 in the queue, and then you'll maybe get a 50% queue penetration, right? Typically, we're on the same page with that. And then obviously on the ultra, I mean, it's even thinner. So it's really difficult to be going on. I mean, put it this way, you're not going to be offering here, are you? You know, because you're expecting that to be taken. But if you don't join the queue and then they do thicken up behind you, like so, they've just added in a couple hundred contracts. But you don't know that, so it's hard to do it on the current bid and ask, which I think is what Dean was saying. Is he's doing that and he tends to get his ass handed to him. But pretty much you're going to need to do it. There'll be an occasion where you can do it if the whole curve is going bad. They'll lift this and then reload. And you can maybe go bid here with the hope it's going to stack up behind you, or you pull. But it's hard to do at the current bid and ask, I would say. But let me know what your thoughts are on that if that's what you're doing. Yeah, I'm with you. I'm with you. So you're obviously you're going to want to be going with the side that's the most strength, obviously. Like right now, you're not going to lay out a bid here because you could easily clear this and then go offered and then you're instantly in a bad fill. I mean, you can lay out here, but then they may lift in and they may cancel it off, because that's the trouble. Whereas now, if you laid out there, you're now 300 better off in the queue. So it's difficult to do that, but I understand your reasoning. Understand your reasoning with it. And then in essence, what you're saying is you're laying out on the bids, you get filled, insta one tick profit, ideal. But then if that gets pulled and it goes offered here, you're kind of trying to get out for scratch, or what volume trigger have you got? So like if they trade, I don't know what, 400 into the next price, you go out for a tick or something. Is that what you're saying? Or if you're using it as a volume stop? Yeah, I'm with you. I'm with you. I think it's much harder to do on the Ultra, to be honest. The only way I would do that would be on the 30. I think doing it on the Ultra would be really challenging, to be honest with you, just because it's too thin. Do you know? Like if they pull the bids, you're not getting out. That's the trouble. And you need to be scratching a lot, probably like half of them, right? Doing that. So like this is the nightmare, right? So they've ticked 100 in and basically the rest is cancelling, you know? 10 years a little bit easier to do it with, I would say, but it's just much thicker. Look how thick the queue is. So you lay out here and do you know what I mean? It's yeah, I agree. I agree. The ultra would be extremely challenging. I think you need to have two tick stop on the ultra, to be honest. At the end of the day, the whole thing about that type of strategy is you're extremely controlling risk. That's the main thing. You're going to be taking what two like worst case two ticks or something. You know what I mean? It's very easy to come back with it. Now, if you're trading like two or three contracts, you only need like what three, four ticks a day or something, realistically. I've been waiting for this to go all day. It's been literally in this range here for like 3 hours. I tried this multiple times to try and crack. 2 year looks like it's going to go. We'll probably lift into the offer here and go bid. Look how thick the 2 year is at the roll as well. Hmm. See if we can take this. Yeah, nice. Nice one. You can imagine how good that's going to be once you've got like extremely good commissions. I know fast track trading doesn't have commissions, but I feel like they're going to stop that at some point, considering they're the only prop firm that does. To put it into perspective, I paid $300 in commission today, which is brutal. Yeah, if I could get that down to like seat level commissions, I would save thousands a month. See that's the problem, Dean, is on the ultra, like your risk to reward is skewed, and typically, so the ten and the 30, specifically the tens, like there's more two-way trade, so it won't like bang through a few ticks and then you're stuck and you can't get out, which will happen on the ultra. The 10 year will tick back and you can get out for one tick or scratch from below or whatever and get back out of scratch. The 30 year, little bit more difficult to do that, but you're going to get filled easier on the 30 year, to be honest with you. Yeah, exactly. I was moving a lot of contracts though, mate. a lot of round turns. Actually, it was actually slightly over. It's 330 to be exact. So you work out how many round turns that was. Yeah, it only works. I think just from experience, mate, that the it's slightly easier to get out of a bad position on the 30 year versus the ultra, and it's certainly easier to get out of a bad position on the tens. The only thing with the 10 years, you're giving away some of the commission advantage trading the tens, to be honest. And in the 5 year and the 2 year, I mean, forget it unless you've got a seat, to be honest. The commission to tick ratio sucks. No commissions is insane. It's insane. Quite a great range on treasuries today, to be honest. Fantastic range. Yeah, no, I think it's FIFO. I think it's the 2 year and the Fed funds that is the key algo, which is why they quote a lot on the 2 year. I think the 10 and the 30 year is just like a pro rata and FIFO, I'm pretty sure. Yeah, it's the 2 year that's like some K algo or something it's called. So you can quote and you'll get like filled the percentage up to 250, so you can jump the queue. But I think the that's the Fed funds and the Fed funds and the 2 year, but the five to the ultra is just five foam, sure. Oh, nice. And just so on the same page, are you going for one tick with an 8 tick stop on that? I mean, certainly you're not going to lose very often. Where it does, it would, I suppose, you just have one bad day and then you continue on, but it's like a full day's graft, I suppose, for one trade. But I suppose it doesn't. If you time it right, it's not going to happen very often, to be honest. With prop firms, yeah. Wow. I mean, that's the thing. Yeah, yeah, that's the thing. That's the thing. Certainly contemplating on leasing a seat, to be honest. Hello. Yeah, I mean, I think realistically, bonds just if you do it at a time where there's not tons of volatility, it typically ranges around. Like for the last 3 hours, the 30-year, I'm not joking, has been between 19 and 14 for the last 3 hours. So, if you had bids out at 14 and 15 and offers out at 18 and 19, you're essentially good to go, to be honest. Basically, if the market breaks above 20s, then you're out. So, so thank you, buddy boy. Much appreciated, my friend. Thank you very much. Yeah, Dean, I would definitely say that the 30 is going to be slightly easier for that than the Ultra, to be honest. You know, the 10 year is the thickest. Then you've probably got, the fives and the twos, then the 30 year, and then you've got the Ultra products. Thanks, matey, though. I could do with a coffee, to be honest. It's been a long day. Feeling it actually for been a Monday. Oh, I need a holiday soon. The weather's been so shit here, so I've not really been getting that much sun. I was down in London on Thursday and Friday last week, and the weather was actually quite nice, which is a welcome change, to be honest. I'll need to see what different kind of stops the Sierra has actually. Because typically I just manage it with a limit, um, straight away. And then if I'm filled in the bed and the offer starts looking weak across the curve, that's why I've got the two to the ultras up. Um, I'll in essence hold it, to be honest. Yeah, exactly. Exactly. I need to have a little dig into it and see if I can try and automate something because it's a pain having to just do it on the limit. I've done it for so long, but I need to try and automate it, make things a little bit easier, if I'm honest with you. You know what I mean? Um, You use the 30 year for practice. CQG demo doesn't have UB. Okay. What platform are you using? Are you using Jigsaw or using Sierra? I'm using Quant Tower. Okay. Okay. How's the DOM on Quant Tower? I've never actually really seen that. What we'll do, or do you guys want to go back to indices? But I mean, I was like watching paint dry, to be honest. This is not very much better. It is a Monday. We'll see if market on close has any effect on treasuries. I don't normally watch at this time, to be honest. See if there's any action. Nice. Yeah, I've heard some quite good things. I just don't think it's the place for the DOM. To be honest, I think it's good for charting. Um, if I was to, I would. Well, I don't know. I've been using Sierra for so long. There's a few things about the DOM that I wish I could change. Um, Let me get rid of these lines here. That's the wrong button. A couple of things like a note column would be great. Just to like click and type instead of having to draw my lines that I mean something in my head. And also if I lay out a bid, it takes up part of the volume profile. It's kind of annoying. Apart from that, it's really good. Yeah, exactly. See, yeah, the Q position on Sierra and stuff is pretty darn accurate, to be honest. Which I think is pretty important in treasuries because the last thing you want is to lay out a bid right now on the 30 year here. You're last in the queue, right? And then they lift 400 contracts and everyone cancels, then it goes bid and you're left with your dick in your hands. You know what I mean? That's the last thing you want. And that's the risk that you trade with the current bid and ask. And I always think it's better to go, a tick below the bid and ask, for example, whatever which way you're planning, to be honest. Queue position is extremely important. You can imagine how it would be like if your commissions were like, 50 cents a round turn and stuff per contract. You've got just ridiculous how many ticks you've got for one. Oh, okay. Yeah. Yeah, it's different prop firm. I would say if it's probably the best for treasuries. I'm really tempted, to be honest. I'll probably do it relatively soon, but it just honestly, it just sounds too good to be true. It's my only downside. I don't really like prop firms in general, to be honest with you. Yeah, yeah, it gives you a rough idea, but it's never going to be bang on. But Sienna is normally pretty close, of course, because it knows all the MBO data and stuff. Well, the thing is, I'm not going to them from one account. I'm either going to do 10 or 20 of them, to be honest. I don't see the point of one account, to be honest with you. The power of these ones is you keep your risk extremely small and you leverage a number of accounts. So you only need to make like a couple of $1,000 trading treasuries and then it's times 10 or 20. That's the way to do it. Plus no commissions. Do you know what I mean? The no commissions is ridiculous. You literally can scratch 90% of your trades and still win. Yeah, yeah, agreed on that. I suppose that's the way to do it. The earlier the policy, the better. Well, mate, I suppose you said it, not me, did. It's just a definition of one, isn't it? Really, it's just absolute cash grab. I can't see that being there in 6 months. To be honest, you know. And also, like, what CEO and stuff posts their sales and things? I mean, who does that? Honestly, ridiculous, ridiculous. Anyway, best luck to the guy, man. He's definitely offering a good deal, but the only reason I'm not doing it like right now is because I can't pay by card, which is kind of annoying me. It makes it even it makes it even slightly more suspicious, to be honest. Yeah, but the thing is, Dean, there's no advantage to go live with any of these firms. I mean, I spoke at this before. So I trade with one. They're going to put me live very soon, and I'm in a I don't want to. What's the point? The commissions are shit, right? These prop firms should have a seat. They've got thousands and thousands of people trading, supposedly in live accounts. Um, you think they would have a seat? I mean, I can go to my own broker, right? And get better commissions than what they're offering. It's shocking. And if you're going to be shifting that in a live account, you need to be, you'd be expecting, I don't know, like 150 around turn or something. If you're shifting that size, mate, because as soon as you're shifting that kind of size, you've now got the problem that large traders have got. You need to get filled, right? And you're not just going to go and flash 100 lots. Here we go, OBS again. Okay, OBS at it again. Trying to disconnect. Yeah, for scale and live sim accounts, yeah, a lot of them have consistency rules though. That's the thing, where you can't really, you can't really get them with huge size. Yeah, I'm back. Yeah, I think. Yeah, OBS is certainly playing at the minute. I think it's been doing it most streams. I actually updated it and stuff as well, which is a nightmare. Below 18s and fill out all this volume below here at this time of day, to be honest. Considering the 30 year in the Ultra is not even below value area low, we're probably going to tick down here and then lift up. I just can't really see us doing that. I mean, the 2 year would need to break, so with the fives, we'll see if they can. We need to see the 30 year get below 14s here. It's trying. I will be extremely surprised if if the 10s breaks below 17s here. You're gonna need to see the whole curve drop down. Consistent rule is not really a problem if you just target X-Men UB and ticks per day. If you want more, you can switch count. Yeah, I suppose that's the way to do it, mate. There we go. Ultras 10s is just lifted. Oh, see if this was any other time apart from the literally market about to close. This is a great short right now, to be honest. 2000 also pulled on the bids. One tick with 10 contracts, 281 netto, aim 1 to 3 ticks per account, and do 10 accounts. Yeah, I'm with you. I would much rather just copy trade them and do 3 ticks and be done with it, to be honest. It's typically how I do it. I just like the copy trade. I couldn't trade, you know, I couldn't trade that long. Yeah, I typically like to. This was a good trade today when this cracked. I don't know why I didn't trade the 30 instead of the 10s. Look at the volume traded here. It's like treble every tick. Yeah, but I prefer to copy trade than do each one. I kind of understand your reasoning for doing that, to be honest. Kind of it makes sense. You're kind of spreading your risk, to be honest. Curious to see what they're going to do here. I kind of get the feeling as if they're going to lift into the offer here, and this is going to pull, and we're going to tick back up to like 19s. We need to see the twos clear halves here, and then same on the fives. I wouldn't be saying this if the 30 year in the Ultra was down at like 11 and 12s, to be honest. I would already be short the 10s. Yeah, exactly. That's the thing, mate. You have a bad day, you do, but I typically have hard stops in all the accounts. So if I have a potato day, I basically stop myself out. Doesn't happen that often, to be honest. Not at all. Which is fortunate. You know, it's a copper trading. You just need to catch risk-free trades if you're trading with 20 accounts, something. I was wondering though, Sierra's copy trader is very, very good. I've copy traded 5 accounts no problems, but I can't imagine copy trading 20, like especially with the queue positioning and stuff, because you know, that split second can make a difference. So I wonder if it would make a difference, if that makes sense. I mean, realistically, you're copy trading accounts and you're only going for, say you're taking 20 of the 25Ks or whatever, you're only going for like 3, 4 ticks a day. Do you know what I mean? You're only looking to make like, I don't know, 125, $150 or something a day, across a month. Across a month, you do really good. So you're really looking to make something like 4 ticks a day, 5 ticks a day. You trim with 10, it works great. Okay, nice. Yeah, I mean, everyone does, everyone does, but the one of the things about putting the hard stop in is it locks you out for trading, so you should normally at least go and get a coffee, um, get some fresh air or whatever, and then come back, um, you know, rather than just blindly doing it because, we've all been there, man. Sometimes you can't get away from the screen, and you need to have these limits in place and a process to stop yourself potatoing. Because when you're scalping, you're only as good as your last trade. You need to try and remove the emotional aspect, and if the emotion does get in there, you need to have some hard stops, so at least gives you a bit of a breather, right? And typically, you need to try and not let a losing day, because when we're working here, in treasuries, you can be right a lot. It's very consistent, but you're gonna have bad days, and you typically need to not let the bad days go off the page. You just want to, whatever you make in an average day, don't let that be more than your losing day, because otherwise you end up having to grind for 3, 4 days to make up a bad day. You know? Yeah, exactly, exactly. But I definitely think the fast track trading one is probably the best at the minute for treasuries. I don't know how you guys have gone with Apex, but I can't imagine submitting a payout with them trading that kind of style. Like, can imagine you just deny payouts quite a lot. They basically want you to trade NQ with one contract or ES with one contract, no DCAing or whatever. Yeah, that's what I'm meaning. And that's what I'm meaning. Like you go into your R trader and basically set your trade windows and um, or if even better, do it with your own personal broker. So you say to them, look, if I lose X amount a day, cut me out, or do it with Rhythmic. So, you know, as you guys were saying, of course you can like stop them, right? You can go in and override them, but right, this 10 years should be lifting this 18 and a half and work its way back to 19 and a half as the 2 year and the 5 year have already done so. And the Ultra and the 30 year is ticked back up to 16s, so it's a nice little bit of edge on the 10s to kind of nudge back into 19 and a halves and work its way back up to 21s to end the session. Let's see if we can do that. Yeah, so that's pretty much it. You're setting the hard stops in so that it auto liquidates you, if you're going full potato or it locks you out of trades and stuff, so that when you click the buttons, it doesn't. Um, I didn't realize that, Max. Nice. Okay, nice one. Nice one. No, I just you get a really bad rep, I suppose. Look at that. Market on close in ES and Treasuries doesn't even move. Right, we want to see if my plan can work if this tens can get back into 19 and a halves. Yeah, I normally need to stream indices because, you either are a treasury person or you're not. You guys can watch treasuries, but majority of people can't. It's like watching paint dry. I just it's completely different market to the ES, completely different. And the good thing is as well is they don't change as much. There's not as many different cycles. Granted, they thin out a little bit, but it's not that noticeable, right? Yeah, I like your style, Dean. That's definitely the way to do it, dude. And you see, this is the thing on the 10 year, right? You can't really trade. There's no way to trade. Do you know what I mean? You can't you can't trade anymore. There's 4,800 in the queue versus 3,400 in the queue. You're not getting filled. Like you might lay a bid out here now and potentially try and ride into 16s. This is not going to get filled in 14s, but you know, kind of clutching at straws. Ladder, how's it going, buddy boy? What's happening, dude? We're just having a nice chilled out end to the stream at the minutes. Yeah, completely different market, mate. You know, years ago, ES was, you know, like ES was like the Ultra 10s. See like this right now? This was ES. You know, like 5 years ago or so, this was ES. This is roughly what the Eurostox is at the moment, give or take. Yeah, exactly. Exactly. And to be honest with you, I'm pretty sure you guys will be the same. I'm not entering treasuries at market ever. I can count the times on one hand that I've ever lifted an offer, you know, with like 10 contracts and it's ever went in my favor. Do you know what I mean? Like, you need to be able to know that you can clean out that offer. Like a wild cowboy. Yeah, it's a great way to look at it, especially last 2 months. Yeah, exactly. So this is just how much has changed. I mean, you know, and my edge in order flow is typically in a thicker market. You know, at least 50. I like 1500s. To be honest, I like this. You know, um, also this is you know extremely. The 10-year RTH is not as thick as this. To be honest, couple it's not as thick as 6,000 bidding offer. Yeah, exactly. The only way you're trading that is if you can lift the full, you know, lift the full offer or hit the full bid. To be honest, if that's what you're doing. Mark it only by accident. I like it. And also, what's quite good as well is like when the bids are off for pools and treasuries, it really pools, and I feel like it's a more honest market in a way. Um, you know, I think there was a great example of that today when we sold through here on let me just stretch this out. When we sold through here on D period, we went through just the bid just evaporated on here. Um, there was 17,000 contracts, well, 17,500 contracts negative delta that come in only versus nine, but the bid was just aggressively pulling the whole way and the offer was reloading. So it's extremely, it's just it's slightly more honest, especially versus like ES. Yeah, exactly. Exactly. Interestingly enough, if brand new traders come into trading and this is how they actually learned how to trade, they would be in the game for longer and they wouldn't blow so many accounts. But everyone, you know, does ICT and jumps into NQ and tries to, you know, call the market or whatever, you know. Yeah, it's just clearer. Like they're all going down. They're all aggressively hitting into the bid, and then reloads happening across the whole curve. As negative delta come in and to top it off, they're pulling the bid. You don't need to be a rocket scientist to know that you should be selling at that point. Do you know what I mean? Yeah, I think ever really since like 3:30 today, which is my head 12, 1, 2, 3. Was that like 11, 11, half 11 or something? Is that right? Half 12, half 1, half 2, half 3, half 4. Let me work that out. I'm being an absolute potato here. Yeah, it's 4 o'clock. Yeah. So ever since 11, since basically lunchtime, it's been garbage today. Look at this. This has just done absolutely nothing for hours. One, two, three, 4, 5. Jesus, man. It's like 5, 6 hours. It's done absolutely nothing. So this should have been end of session, and I was basically hoping that this would crack. So we took a couple of scratcheroos in here, and I think we ended up break even, lost a tick, took a tick, to be honest. So good question, Lather. So basically what you're saying is how do these large firms make money and how do they consistently make money, right? Is that basically what you're asking? Well, I'm going to be completely blunt. The game's not fair, right? They have better latency, better software, more analysts, more resources, better commissions. They'll get rebates on their commissions as well. They're friends with the exchanges. They've got better data. Every single part of what they have is improved than what we're doing, right? And very typically, they have almost say two sides to their own book. They'll be trading shareholders and the bank's money on a desk to basically make returns, but then they'll also be taking positions on behalf of their clients. And very typically, it's their market, right? So, say for example, they know that they do the majority of volume in a specific market. We'll just, I don't know, just take one, just call it the Ultra Bond, right? I'm just spitballing here, right? But say for example, they take a call from a client that says, right, we want to we want to do a block trade and we want to buy, 2,000 contracts of Ultra Bond. The market's currently at say 30s right now. Well, they don't give them the price of 30s. They'll quote them, a price below the bid, so they make commission on that. And then they then decide, do they want to give them that inventory or do they want to work out their position? So very typically they'll get off the phone and they'll say, right guys, where are we at? What are we net long? What are we net short? And then they'll quickly work out the position, and they'll have quants that'll be on the desk now where they'll just put the algorithms out to work, for it, because a lot of these guys are not point and clicking, of course. You know what I mean? They'll have algorithms that will be already pre-built, um, that's already worked how to get the best positions for those specific markets. So they're instantly quoting prices that puts them in profit, and then they can work out those positions. So just as an example, very very simply, right? If you know that 2,000 contracts are coming in the market at say 28s, right? And they said they want an average price at say 28s, you know that you can go and sell to 28s because you know you're going to go and buy it back up, right? That's information that they're privy to that we don't have. They know they've got thousands of contracts coming in because they've got to get an average price today. So they can work the book because they know that they can basically buy it back up. So they can aggressively start selling in and start working it. It's basically how it works, mate. Because realistically, they are the big traders, these guys, right? We are waiting for big traders and flows to come in to give us an indication of where the path of least resistance is. But these guys have the money to move the market. You know, can you imagine right now that I just said that the market was down here at 18s, right? And say you had 4,000 contracts laid out here. Just say it was you personally, you'd 4,000 contracts laid out here, and you think to yourself, right, if this does take this out, whack, I've got 4,000 below here. So when they start selling in here, you can probably start buying some here because you know that if the market comes back up, you're going to buy it back up anyway. You know what I mean? That's a completely different ball game to you and I chucking in 10 contracts in here to trying to get the market to go up a few ticks. It's not even remotely the same. You know, money talks. And the thing is, as well, is because their commissions are so much better too, that's an edge in exchange. We're still not going to get as good commissions as them because the market making firms, they get better margin, better commissions from the exchanges than what we ever will. So that's an edge in itself. Hey, Pike. Nothing. We've just really been chatting, to be honest, just watching treasuries. Nothing too exciting. But did that make sense, Ladder? Yes, Pike. Nice spaceship. I'm just going to Pluto. And also, just to show you open time and sales, even at this time, look at the size of contracts that are coming in to the 10-year. Completely different. Hundreds and hundreds that come in all the time. So you're right, the market is going to pull into 19 and a halfs. The giveaway for that was the fact that the 30s and the ultra was not below here, and we gave us a nice giveaway that the twos and the fives basically ticked off. And again, the market's not going to break these lows at this time. Sadly, you can say that, but you can't get filled because there was so much in the bid and offer. 10,000 contracts traded to get that up one tick, and then the reload 5.6k. You mean so per fluctuation for the 10 year, it's $15.65 per tick. Just call it $15. $15 a tick. And then the 30 year is $30. It's actually 31.25, but just for easy math, we'll just call it $15 and $30. And then the 5 and the 2 year is half that. So it's basically the full tick is the ultra and the 30, then it's half for the tens, then half again the lower down the curve you get. So it's a lot of money, man, that they're exchanging. It's 10 years the most liquid. It's the most liquid product on the planet that's traded. I suppose you can say that FX is, but it's not centralized. So yeah, exactly. That's a really good question, Lather. So basically, Goldman Sachs, right, will be speculating that say, the 5 year, the 5 year note, right, 5 year Treasury note is going to go up. Now, on the other side, you have futures contracts are mainly used as a hedging mechanism. So all these products that you see here, you have large banks that are basically hedging off their mortgage portfolio risk, who don't really care if the price goes up or down because they own the physical, we'll just call it physical delivery contract of that. So they may be hedging off a 10-year exposure or 5 year exposure mortgage there, because the Fed is going to increase or decrease rates. Um, so they're not caring. So they'll provide the liquidity, for example, to Goldman for Goldman to buy that 5K. But the bank doesn't really care about the end price because they own the physical contract. They're just actually hedging off the risk. But Goldman is a speculator that ultimately wants the price to go up, right? So you have two participants in these markets. You have commercial, then you have non-commercial, and then you have retail, of course, but they're you know not really counted, to be honest. Really, really small firms and retail that don't really count. But that's typically how they would work. You can look at the commitment of traders report or the COT report to look at that if you want to see that. Very typically, the large speculators is getting the liquidity from the commercial side for that specific product. So just as an example, if you look at oil, that would be like BP would be hedging off their, you know, oil that they need to sell for gas and diesel and and all that kind of stuff. And then your hedge funds and so on would in essence be, they would be speculating on the future price. Does that make sense? So that's how that essentially works. Because BP is hedging off exposure for the physical delivery, so they don't really care because they're looking to lock in their actual margin on the product. Does that make sense? What even is what's the notional value for? I don't know. I need to check. I can tell you what the margin is, but like without leverage, I would need to check. I think it's over. It depends if it's going to be overnight margin or day trading margin or no leverage. To be honest, I need to check exactly what they are. Um, yeah, yeah, exactly. And a lot of the time, a lot of the time, they'll be hedging themselves. So they'll maybe be doing a spread play where they're maybe trying to either flatten or steepen the curve. So they'll maybe, buy the long end, um, and short the short end, for example, or vice versa. They also maybe have money in the actual yields. They maybe have some position on oil that typically is tied to inflation. There's loads of ways to cut it, but very typically their liquidity that they're providing is it's going to be done by the commercial side. And I suppose when you look at these markets, you realize how little retail has got to do with anything. Like, no one is looking at treasury markets and saying, "Oh, they're hunting my two lots or something." Do you know what I mean? Look at the thousands of contracts trading here. So not saying you guys are saying that, but it really hammers it home, right? That um, the market goes to certain areas where stop runs happen and where liquidity is so that it can get filled because the market's efficient that way. And there was a couple of key points today where Treasury just went and there was a lot of stops that got triggered. They are the best trades. It swept through this exact area here. I think it was exactly this point. It swept through here twice on the way up, and then when we flicked through in D period, it just capitulated right through it. It was a thing of beauty. And they're typically just going to go through single prints. The first hit of single prints when they're left and it goes back through them are great trades, because typically there's not really much resistance that goes through them. Yeah, for these large accounts, Pike, I don't think so. I don't think these guys need to worry about margin, to be honest with you. Um, like in order to trade 2,000 contracts, I mean that's crazy. And also they may actually hold. Like here's the other thing about treasuries as well. They may actually hold bonds, and they're hedging off some of the coupon risk or whatever. Like they'll do that at bond auctions. This is the thing. We could go here all day. There's so many different ways that these markets move, and really our job is to find the path of least resistance. To be honest, when everyone is buying, you want to be buying. When everyone is selling, you want to be selling. Like if I can show you this was the move today, in my opinion. This one, it sold off, and then the market just absolutely shit itself here. And when it swept through this area, it just went, in D period here. So it started off pretty weak. You had some selling coming in, then the bid was just pulled, and by the time it broke here, it just it just really went. It would have happened on every other setup as well. But this wasn't just a 10-year, it happened on the whole curve. So it's not like this happens on the 10-year while the 30-year is at the highs. Do you know what I mean? They all work in tandem with each other. They're extremely correlated, which is why I have these up. Like 2 billion in one good trade. Yeah, exactly. Exactly. And then this, when it went down here, we swept the low by a couple of ticks, and it just went straight bid. Took me a little bit longer to catch this because I was hoping that we would basically start absorbing here and then crack the lows. But I took a scratch on the way up here, and then I was like, right, I'm now buying this because the whole curve was going up. So we basically bought and we took 3 or 4 ticks on the way up. So it was, which was nice. But I'm kind of ticked off at the amount of commissions I'm paying, to be honest. Your dom, is that? Yes, yes. This is my dom. Yep, yep. Completely, you know, my own built. It's taken me years to build these damn things, but slight variation to things where you can see, ATR extensions, value area lows, previous day close, yesterday point of control, volume profiles, VWAP, got initial balance on there. You can also see the MBO data as well. You've got everything there. About yields, how do you take advantage of them? I know they're inverse correlate and some spreading can take advantage, but how do you implement that for short-term trading? Can you explain it? Okay, so very typically the yields, right, are 100% inverse to treasuries, right? So very very typically, if the 5-year yield is going up, the 5-year note is going down. Completely inverse, right? So you want to be they are their own markets in their own right as well. Um, so there's a good way on TradingView to have a look at it when I'll actually show you this. Chrome. Let me go into TradingView and I'll show you this. Give me a second here. TradingView. Okay, let me know you guys can see this okay. Super charts. And then, okay, so this is how I basically have my morning coffee with this. This is the 2-year, the 30-year, the 10-year, and the 5 years. You can clearly see that. This is currently the yields right now. Okay. Now it's kind of sorting itself out. It was extremely inverted for a while, only a couple of months ago, where the 2-year you were getting more money for the 2-year than you were for the 30-year, which is basically broken, which is the great sign of the recession. So it's now starting to sort itself out. But what a very typical yield will look like, so let me go back. Is this a 1 hour? But let me go back to the daily actually, and I can get it a little bit quicker for you to show you what a typical curve is going to look like. Okay, so this is what the curve should be like this: 2, 5, 10, 30. Okay, buy the 2-year yields. You make less money than buying the 30-year, right? Obviously. But as the market changes and different Fed regimes happening, different easing, different tightening, things along those lines, this then happens. What is quite interesting is the last time we had this so inverted, by the way, was 2007. Believe it or not. Let me go back to that, if I can. So I'm now on a tangent, guys. I'm sorry. So last time we were extremely inverted like this was 2007. Now, if you guys remember what happened then, that was not great, was it? Kaboom happened. So last time we've been so inverted. Ever since then, the market has been completely different. And now we're inverted. So This is like my morning coffee. Have a look at it, draw out some levels, just see what's happening. I really like to follow the general sentiment of the market to see what is happening because very typically the treasury market hates inflation, pretty much hates it. Do I use any counter correlations? Maku. So, of course, I use the yields, which is kind of the true one, to be honest. I do have a look at the dollar index and then, of course, some of the safe havens. But to be honest with you, they don't really work for tick basis, to be honest. Like I have them on a different screen and I'll maybe look at them to see what the sentiment is to see if they're at key levels that maybe help treasuries inversely. Um, if that makes sense, but it doesn't. It's not like the dollar leads or anything like that. Do you know what I mean? I wish it did. It would make life a lot easier. And then as the ES, sort of inversion, I don't even look at that. It's so unreliable that it kind of gets me in more trouble than what it does, to be honest. Miranda, was it worth it? Yes, certainly was. So can I not do that? That you mean the yieldy thing, Maku, that I just had up on TradingView? No, no, sadly not. It Sarah chart doesn't support the yields, or I would probably have on a different screen. I would have the different yields up because that would be glorious. I wouldn't even be if I had the yields. What the bid and offer was on the yields. I wouldn't even look at dollar index or Swiss francs or yen, to be honest. But Randy, yeah, it's definitely worth all the hassle, mate. But this has been years in the making. This, it's not like I did this overnight. I've tweaked and I'm constantly tweaking it. To be honest, the only thing I never change is the DOMs. I'll maybe ever so slightly change like how I look at footprint or something, or the market profile, or maybe sometimes go from include the Globex session for current session, instead of just having RTH like that. I'll maybe change, but the DOMs stay the exact same because they're the things that I rely on the most. Um, but yeah, love to be able to look at the yields. I actually think Rob, who trades treasuries a lot, I think he's got something for Jigsaw in there. I think Jigsaw maybe has that facility where you can look at the yields in terms of the bid and offer on them. And yeah, Pike, the way that we interpret the market here and on this channel is completely different. You know, um, you've got to be a critical thinker in life, and typically you would like to think that this is exactly how the market moves. That some of these dudes are actually saying that there's one algorithm that runs the market. I mean, it's just so ridiculous. It's such a lack of understanding of business and the market and everything. Do you know what I mean? It's crazy. Anyone that's been trading for many years doesn't think that, you know. Yeah, Miku, I would definitely say, mate, honestly, for me, it gets me in more trouble than you know, more trouble than what it's worth. I think it would be better to add in some of the curve than it would be um than it would be to look at ES, to be honest. I think the 5 year typically is a good one to add. In fact, to be honest, you could take away the two and the two ultras and just have the 5, 10, and 30. To be honest, but yeah, it typically helps. When treasuries goes, it tends to go in tandem a lot of the time, and it gives you a real idea where you can just look at, um, are they buying the long end and shorting, the short end, or selling the short end. You can very simply see that if one is kind of out of whack, and sometimes there's some spreading happening. And I think the easiest trades are when there is none of that happening, and it's just one direction, and everyone's buying, and you know offers have been pulled, everyone's buying, reloading the bid, and you just, hey, can I join, please? And you join, and then everyone else buys, and you're like, woohoo, that was easy. You know, that's the way to do it, or at least for me anyway. But it's the only market that you can simply, call a reversal within 1 and 2 ticks. To be honest, very hard to do that in any other market consistently. Oh, so you have them all? Okay. Oh, so you already have all the buddies up. Okay, sweet. Lad, I've been contemplating this over the last couple of months, to be honest. um, like I would still point and click, but I would like to have the algorithm manage the entries and exits. To be honest with you, set some parameters in there and have it manage. But again, you need to have really low commissions. You don't need to have really low commissions, but it doesn't. It's a massive, massive difference. I mean, if you're 80 cents a round turn, you've got the guts of, like 25 trades or something at scratch with one tick for you to be profitable. It's not, it's completely different. Ah, is that the Grady setup, Maku? Miranda, uh, you know, I've been doing this for many years, right? So practice, practice, and practice. There's no way that you're going to look at this and instantly get it, right? Uh, you need to get good on one DOM and then gradually add them, and to be honest with you, I'm not analyzing every number on these as an example. I'm just very typically seeing, right, this middle line, for example, that I've got across here. If I recenter, okay, I can see that where everything is across the board, right? So if something upticks, I can then quickly glance it and I'll catch it in my peripheral. And then Treasuries is very sensitive to like lifting a price and then going bid, right? And what I mean by that is they take out this full 1838 and then they clear that with size and then they then reload the bid. Because what you'll find is when you do this in the 2 and 5 year, right, then the offer will basically start pulling here, for example, right? Does that make sense? So if I catch in my peripheral and I look and see the fives is went bid, it's lifted the offer and went bid, this is then going to start pulling, right? Or drop some contracts off it. So if I've got an offer laid out here, because I'm looking to get filled here in the queue to get a tick, as an example, I'm going to quickly need to cancel that because these guys are ticking up. They shouldn't be doing that. They should all be ticking down. So you'll quickly get the hang of it just over time. You know what I mean? You're not looking at every single number. You're seeing the size that's been traded. You're seeing if it's going bid or offered. These are this is the main market that I execute on to see what's happening. Very typically, they look kind of the same, anyways, within reason. Maybe a little bit extended on the 30 and ultras, just because they move a little bit more. But that's typically it. But definitely start with one and then add them because correlations are extremely important in the market. Extremely important. And the thing is too, you need to start like if you've not worked your way through that playlist, I would advise you probably work your way through that because the products are completely different nowadays. The indices are completely different. They're now changing. We covered that on today's stream where there's just buying and selling programs are hitting in one lots to move the market. That's a completely different. Like I didn't learn on that. You know, that's more like what's that guy that does the fast entries and exits, the flat jacket guy. Uh, what's that guy's name? You guys know what I'm talking about, don't you? Got Norden, that's it. Gary or Graham Norden or whatever his name is. I think it's Gary. Um, his side of things is more, sweeps, reclaims, quickly getting in, getting out for like three ticks and stuff. That's more suited to the way ES is at the moment. Also, it's summer months, so there's just no real size. It's just the market's moving by drilling algorithms and bids and offers being pulled. I prefer markets that are thicker, they're easier to read, they're slightly more honest, you know. And I don't typically stream this because it's when you're new to trading, this is the last thing you want to look at, right? Six DOMs, multiple things. No one really, unless you're in treasuries and you know what you're looking at and you've traded for a while, it's not the easiest thing to look at. It's much easier to look at a candlestick chart, you know. And the majority, I would probably say, 99% of retail is not trading, fixed income. They're trading, you know, ES or NQ or something. It's not anything that I've traded that for years as well, but it's just you've got to change and adapt and realize when your edge is changing. To be honest, I'm the first one to admit when if I don't know what's happening, I'm not trading. You know what I mean? or if I can't limit my downside, and you know, because I'd much rather come in for a day and know like what I can lose, if that gives me enough tries at it, and plus as well, it's nice to be able to like get in a trade in treasuries at times if you know you're going to hold it and go get a coffee and come back and it's not moved. you can't you can't do that in a you can't do that in any other market. So look at that, 12,500 contracts lifted into the offer here. Let's see if they lift that. They don't, then they reload here. I mean, there's 1 minute in the market left. But yeah, it's just different. It depends what you've learned in, to be honest, and what you prefer. And I would advise you try different markets because you may find that one suits you better, to be honest. Um, that would be what I would suggest. Let's see what you guys are saying here. Yeah, great. John Grady's a bond trader, typically executes in 30 and the tens. Good question, Ladder. You're asking all these good questions, dude. So, I'm looking at that Metastock thing, to be honest. I'm tempted. Probably going to try it out just after the summer months, to be honest. Um, so for example, my notes today on durable goods. Let me have a look at that. If I can read my own handwriting, that would probably be great. But notes on durable goods today. Okay, previous 6.7, forecast 4.9. Um, Let me see. I was expecting a range of -2% to 5.4%. The lowest for this year has been 6.7% as an example. So I basically work out what I'm thinking is going to be in a range, and if it comes out on the squawk that it's above my range, which I've normally always got the highest and lowest noted out for that year, I'm basically going with that, to be honest. And then the same for durable goods, for example. So I actually today, which is a bit of a weird one. So that number came out in 9.9%, the highest print for the year on durable goods. We hit into the bid at the start. I was short and then instantly got hit. We then went bid, and I realised that I need to take my analysis and ram up my ass. And then I was buying, and then the sell off happened. So we went up. The actual sell off from durable goods happened in D period, to be honest. So yes, I do play news plays, but typically it has to be something that is pretty obvious. Like if it's if everything comes in line and it's all in forecast and there's nothing that's going to shock the market, then I'm not doing anything. Probably one of the most obvious ones was in the last, I don't know, couple of weeks. Retail sales come out at 1%. That was like way above forecast, highest print for the year. Um, Treasuries absolutely hates that because that shows growth, which means the economy's doing better. Bonds hates that. Bonds is like, I want weak economy, you know. So yeah, just typically it all depends what the market you're trading and how to interpret it. Basically, if it's good for the dollar, it's bad for bonds, typically. But I'm watching all these numbers. I have a little nothing fancy. I write down all the numbers in a diary, and just refer back to them. Just have a highlighter, highlight the colors depending on what I'm happening. If it's above this number, I'm buying, or below this number, I'm selling. And if it comes in within line, I'm not doing anything. But if it comes out in a standard deviation, you better believe everyone else is doing the same thing because that's what they're anticipating, right? If you do that and you're quick with it and the market goes, you're going to instantly find yourself on side. Am I doing these trades full clip? Absolutely not. I'll size down on them because I've got more room to move. And then if it does really go and the full curve is going, I'll maybe consider adding to that position so I'm in full clip. And I use a mix between Financial Juice, Forex Factory. I use quite a few of them just to get an average, and some of them are slightly better than others. I would say sometimes they have a bit of a boo boo and mess up. They did that the other week actually. Um, uh, Miranda, I would say that if you're in that sort of break even stage, it takes some real deep dives into your numbers and stuff. We can maybe assist with that, but are you journaling intensively? You need to see what products you're trading. You need to have a look at your max adverse, max favorable excursion. Um, you need to have a look at your trade windows. You're paying too much in commissions. Loads of different things you can tweak. Are you losing too much in your losing days? There's loads of little tweaks you can make, and sometimes it's good to have eyes on it. It's good to have eyes on these things, a second opinion. Because when you're a break-even trader, you're not far off. That's the thing. And really, your journaling is gonna take you over that stage. That's the key. Yeah, exactly, mate. That's the way to do it. Um, you know, and it's really small tweaks you need to make, and you need to have a really good procedure in there. It's takes time. If you want to have a look into the coffee, there's something I do to assist in there. I don't teach a strategy, just to make that clear. Um, I do exactly that, where just basically run over everyone's numbers and have a look at it. Um, but I'm never going to come out with selling a course or whatever. I just couldn't. I couldn't do that. Sadly, showing someone a rectangle where to buy and sell is not it. Uh, you know, but if you've got an edge and you need the edge implemented and tweaked ever so slightly and so on, that's where experience comes in and can assist. So that's the only thing I can really help with. But if people come to me and they're like, I don't know what a bidding offer is and stuff, you know, I can't really help with that. Well, first things first, you need to get yourself a sample size, mate. If you're not trading, um, or if you're trading prop, just export your stuff and then you can send it to me and I can create a portfolio or something for it. Um, something along those lines is typically how it would work. Yeah, exactly, Pike. Or trend lines and all that stuff as well, sadly. I mean that trend line stuff where people just start drawing random trend lines is just, you know, you might as well just draw squiggles on the chart. You know what I mean? Like, do you think when thousands of contracts come into the offer that it really gives a shit about if there's a damn trend line there? Do you know what I mean? It's crazy. You need to try and break trading down into the most common denominator, and what moves any market is money. And each contract you're seeing here is money. Yeah, whenever you're ready with that, Miranda, have a look and I would say definitely get yourself journaling. If you've not got a journal, try the TraderSync one. There's a link in the description here where you can trial it. I think it's a couple of week free trial. Make sure you're getting the level 2 so that you can get MFE and MAE, or if you've got Jigsaw's Journalytics, then happy days. Just really depends what you're looking for. Really good question, ladder. Good question. So I can tell you that basically 75% of the time, if we take the previous day high or previous day low, we close in favor of the break, above or below settlement. I think I've just butchered that. If so, say for example, we take previous day high, there's a 75% chance that we then close above yesterday's close price, typically. That's in treasuries. Um, I can tell you what the AT. That's why I've got ATR and ADR marked on the charts here. So it's 50%, then 1 times the ADR. Typically, that's done over the last 3 years of historical data. That takes into account all ebbs and flows. Um, how often do we break overnight highs and overnight lows in treasuries? We, believe it or not, typically do that like 90% of the time. So all of these types of little things, you know, working on your edge and statistical edge like that can definitely help because again, algorithms will know that instantaneously. Do you know what I mean? And they'll be continually tracking that. Do you know what I mean? So you should be too. But yeah, I've typically watched that stuff like that over the years, dude, and just sort of journaled it and tracked it and things. But typically it's things like average daily range or ATR, um, previous day high, previous day low breaks, weekly high, weekly low breaks. What happens once we take those levels? What's the most probable close price for that current day? Things along those lines. Because it can provide an edge that if that happens above, say 70% of the time, then I know that I can be, a buyer below the previous day close that gives me a potential edge on that closing above, because it happens 75% of the time. That's where you typically sticky notes. Sticky notes, Spike, are good. You know, typically have the sticky notes for it. Things like "Don't be an idiot" and oh, "Trade what you see." It's two sticky notes I have. Yeah, exactly. Holy would be nice. I wrote on the screen. I like it. I like it, dude. We're currently looking at a still screen here, so I think I've maybe overstayed my welcome. I hope you guys have enjoyed my rambles. Okie dokie, guys. You have a great evening, and we'll be on same time tomorrow. Trying to see if OBS behaves itself so it doesn't crash. But you guys take care and have a great evening. Safe trading tomorrow, everyone.